Hey everyone, happy Monday. Welcome back to my channel. I'm Caitlin McCagg. I am a real estate broker here in Phoenix, Arizona, and thank you for joining me on another Monday market update where we talk all about what's going on in the Phoenix real estate market as well as the overall economy. So let's jump right in. It is the week of Christmas. I am feeling very festive this year. It's been kind of cold, so maybe that's why have my big flannel on today, but I hope you guys are all ready for the holidays because they are upon us. So we had a big week in the economy last week. Let's start talking about the CPI. We got this data last week. Last Monday, I said we were going to have this on Tuesday. Of course, it came in on Tuesday and actually came in lower than expected, which is one of the first times we've started to see this movement in the inflation data going the right direction. So consumer prices rose less than expected in November, up 7.1% from a year ago. 7.1%, still rough, but the expectation was lower than that. So we actually saw a 0.1% decline, or a 0.1%, which was lower than the 0.3% expectation. And year over year, came in at 7.1%. Instead of 7.7. So inflation is on the decline. So that's a good thing. While this is positive news, we're still far from the Fed's target of 2% inflation. So we certainly have a ways to go, but at least we're seeing some movement in the right direction. This goes on to say core CPI rose 0.2% on the month and 6% on an annual basis compared with the respective estimates of 0.3% and 6.1%. So again, all positive news from this CPI data, which we've been wanting to hear for a while. So that was Tuesday. Then on Wednesday, the Federal Reserve met and increased their interest rates to increased another 50 basis points. And so this article says Federal Reserve raises interest rates to highest since 2007, sees higher rates in 23. So this is a little bit of a confusing headline because really the interest rate hike that they did last week was on the lower end compared to what they've been doing every month. But what this is talking about is the terminal rate. So the Fed has increased the terminal rate to about 4.25 to 4.5%. Their target at this point is to get to about 5%, 5.1%, somewhere in there, which is basically where they want to end up with these, with the federal funds rate. So that's why every time they meet, they increase it a little bit further, and expect to end at a certain point where they believe inflation will start to go down. So now looking at that number as being about 5.1%. Back in September, they had forecasted that number to be about 4.6%. So that's what this article is talking about, that has been increased, that target, and we're at a point, like I said, we're at about 4.25% to 4.5%, which is higher than we've seen in a while. So expecting to see the Fed to hike the interest rate again in February, probably about 25 basis points. Again, this time was 50. Next time, maybe 25. So Jerome Powell, who is the chairman of the Federal Reserve, talked about how we have seen, some improvement, but he's not totally satisfied, and he's certainly not pivoting his strategy at this point to stop these rate hikes. So after the meeting on Wednesday, he talked about how even though we've had 2 consecutive months where we've had lower CPI and PCE numbers, employment is still at capacity, and the economy is still growing. And I talked a little bit about the job market and employment last week, I believe, or 2 weeks ago, and we still have a really strong employment landscape and job market. And so we're not seeing a whole lot of weakness there, which indicates that what the Fed has done so far has not taken effect yet on that end to slow the economy. So that's what he's saying. He's not confident that he's seen enough to change the economy to slow down to where we want to be able to slow their pace of increases. So he's saying that the data that comes out between now and February will be a big indication of what they decide to do on the interest rate in February. So we'll see what happens. At this point, it's good news because we are seeing some movement on inflation, which means that we're getting closer to a point where they can stop increasing the interest rate. And, all of this is important. Why? Because it affects housing. So the federal funds rate is not directly tied to mortgage rates. However, what happens with that affects the stock market, which then affects mortgage rates. And so, interestingly enough, this last week, according to my sources in the mortgage industry, didn't have a whole lot of effect on rates. We didn't really see any improvement or, anything good or bad really with rates. I think they kind of stayed stable. So we'll see how that happens or changes over the next few weeks through the holidays into the new year. But for now, nothing too crazy has happened. Wanted to also share this article here that says housing affordability is deteriorating faster than at any point in its data history. Here's 2 simple ways to buck the trend. So basically, the article says that the affordability for housing is not good, which is true. And the 2 options are to either move or wait. So it's not really a genius article, but I did want to share because it does talk about the Phoenix here. Inventory rose fastest in Phoenix, 167.3% higher than last year. So they're talking more about the surge of inventory that we saw over the summer months, calling Phoenix out along with Raleigh, Nashville, and basically saying that you might have more of an opportunity to have lower prices because of a surge in inventory. And then it also talks about your other option is to wait and see if prices continue to go down because of the surge in inventory. And so I just find this interesting because we're certainly not having a surge in inventory right now in Phoenix. So this is a little misleading depending on if you don't know much of what's going on in the Phoenix market, that is not our problem at all. We actually are the complete opposite, where we have just a very low number of inventory right now, and lower than expected. And I'm going to talk more about that. But I just wanted to point this out because these national articles aren't always accurate or very helpful. And obviously, move or wait isn't really a genius piece of advice. But anyway, affordability is in a rough spot. They are correct there. So talking about our inventory, this is a very interesting article that I also wanted to share about this mortgage rate lockdown, or the lock-in effect, I've heard it called as well. But basically talking about how there are so many people with such low interest rates that we don't see a whole lot of movement in the housing market right now. And I think that's really true. We're really feeling a lot of that. This is saying that so many American households have such low mortgage rates, some will never move once rates rise, which then locks up housing inventory. Something I've never believed, because we hadn't had a period where mortgage rates moved up so quickly and then held higher for an extended period, but now this is a real risk. Now, this article is from September, so it is a little bit dated, and you can tell that as you read through, and they talk about where rates are at, and a few different things in here. However, I think we certainly are seeing the effects of this lock-in effect because we really have kind of a stagnant inventory right now, and that's been completely maximized or whatnot because of the holidays. Right now, it's a total seasonal time for us where we tend to see very little inventory coming to the market, and that combined with, I think, this lock-in effect with people that are hesitant because they don't know where things are going, we're really starting to see everything slow down significantly. And it'll be interesting to see how things change as we get into the new year. I think probably by the third week of January, we will start to see which direction the market is going to take. If we're going to start to see a lot of new listings or if things are going to stay pretty low. But I'm going to talk more about that because we have seen a big change in the CMI, mainly because we don't have a whole lot of supply. So let's jump into that. If you're new here, I follow the Cromford report, and they are an awesome publication that gives great data to their realtor subscribers. Here is some information about active listings, 18,600. So this is exactly what I'm saying and what we're seeing in Phoenix. We were at 20,000, almost 21,000 back in October, and things have only gone down since then to about that 18,000 range is where we're at today. I would expect this to probably go down a little bit more before we get into the new year, just over the next couple weeks, more than likely. And so we don't have inventory oversupply. Back in 2007, 2008, this number was at about 50,000. So much, much lower now. But you can see we did have this surge of inventory in the summer as things changed. And we did have a lot of people that were kind of concerned about what was going to happen with the market, wanted to cash in while they could before things changed. And everyone decided to list their house. So that's what happened there. And now we're kind of falling off of that. But we'll see what January brings. So let's talk about the CMI this week. We are up from last week, 91.8. We are officially back in a balanced market according to the Cromford Market Index. Excuse me. And if you're new here, the Cromford Market Index is a measure of supply and demand factors in our market. You can see here we have demand at 71.2. And normal demand and normal anything in the CMI is about 100. So demand is about 29% below normal. Supply is about 23% below normal, roughly. So both demand and supply are lower than normal. They're fairly close to one another, which is what's putting us in a balanced market. But demand, if you recall, has gone up. I think last week it was like 70.5 or something like that. So we have seen a very small uptick in demand, and our supply has also just stayed really low and started to drop a little bit. So having lower supply and just a slight uptick in demand has taken us back into a balanced market and out of a buyer's market. And you might be shocked to see this week's chart of all of the cities. I hope you're ready. You won't believe your eyes. Look at all of that green. We've not seen this many green arrows on this chart in quite a while. There are only 3 cities on here with a red arrow. And excuse me, a red arrow means that those cities are deteriorating for sellers. So it means they're heading in the direction of a buyer's market. Now, keep in mind, anywhere between 90 to 110 is a balanced market. So this is at 114.9 in Scottsdale. That is still in a seller's market, technically. It's just deteriorating, going more towards a buyer's market. Goodyear and Maricopa are both in buyer's markets and getting worse. So that's what those two mean. But everything else has started to move in a positive direction for sellers and started to move away from a buyer's market, although we have a lot of green arrows that are still buyer's markets, like Buckeye, Queen Creek. We also have Surprise, Peoria, Avondale, Mesa, Gilbert, Tempe. All of those are still technically buyer's markets, but they are improving for sellers. Now, we do have Glendale and Phoenix that just, and Chandler that all bumped into the balanced market area and had been buyer's markets. And then, of course, we have a few cities that are still in a seller's market, anything over that 110 mark. So Paradise Valley, Scottsdale, Cave Creek, and Fountain Hills, all still in a seller's market, if you can believe it. So This is really interesting. I have to say, I think a lot of it is due to the holiday timeframe. We just don't have supply coming on, and what has been on, we got a small uptick in demand because mortgage rates have started to go down over the last 3 or 4 weeks. And so maybe some buyers came out of the woodwork and decided to jump at it, and ate away some of that inventory. And then people just don't really list their homes right now because they know there won't be a whole lot of activity. So it will be interesting to see if this green holds as we get into January, or if we're going to start to see this all go back to red again, and we see more supply come to market, and a lack of demand. Not really sure. Not really sure if we're going to have some demand come out of the woodwork or not. It might be interesting. I could see it going either way. I can see buyers continuing to wait on the sidelines because it is expensive and rates are still high. Or I could see those buyers who've been planning this all along and not saying anything about it, but decide to jump in because it's a new year and they want to look for a house. So it remains to be seen. I am not making any predictions on that at all, but that's where we stand this week. So let me know in the comments, are you shocked to see all of those green arrows? Because I certainly was. I didn't expect it to flip that much. And we are technically back in a balanced market. So we'll see what the crazy Phoenix real estate market does moving forward. I have lots of great stuff for you guys in the description if you ever want to check your instant home valuation or search for homes in the Phoenix area using my MLS. Make sure to check that out. And of course, if you have any questions, you can reach out anytime. So come follow me on Instagram at Your Phoenix Real Estate Agent. If this was helpful, hit the like button and subscribe. I'd appreciate that. And I will see you guys next week with another Monday market update. I hope you have a wonderful Christmas if you celebrate Christmas. And I hope you enjoy some time with family. So thanks, guys. I will see you next week.